Hey everyone, it's Wolfgang. This video is sort of a follow-on to yesterday's video, which was profit buying businesses. Yesterday I talked about a technique to buy a succession of businesses and to sell them over a period of time to sell the larger entity for a pretty substantial profit. So this is going to be an actual example of a business. We're going to buy the first business in that process. But I'd refer you to that video from yesterday because it's got the outline, the background of this. So this is a safe way to acquire a first company if you have no experience and you don't have and you've never bought a business before. We're going to buy a needs type of business as opposed to a wants type of business. If we were buying an ice cream store or a candy store, that is not a need. In an economic downturn, those kinds of companies suffer because they're not selling something that consumers need. They're selling wants. This business is going to be a needs type of business, something that people have to keep buying even when the economy slows down. So step one, we need to talk to the seller of the business, get the gross revenue, the total revenue for the year, probably the most recent year, and then calculate the gross profit, which is revenue, annual revenue, minus the cost of goods sold. The cost of goods sold is the expense, the amount of money the business paid to produce the tangible thing that gets sold to customers. So gross profit is revenue minus that expense. EBITDA is the gross profit minus additional expenses the business has. These are expenses, things the business has to pay for that do not create a tangible product or service. They're things like rent, utilities, and insurance that keep the lights on and the doors open in the business, but they don't actually, they're expenses that don't produce a product or a service. So EBITDA is used to determine a sale price for the company. It's a really important number. Gross profit minus operating expenses is the EBITDA, earnings before interest, taxes, depreciation, and amortization. And then this is an important number, net income. This is what a new owner can possibly take home each year from the company that they buy. It's the EBITDA minus taxes they have to pay in this case. I want to say something about that. EBITDA is earnings before interest, taxes, depreciation, and amortization. In this example, the only one of these is the T, taxes, that this company is paying. They don't have any outstanding loans. They're not paying any interest. They don't have any depreciation write-offs. They don't have any depreciation expense. They don't have any amortization. They only have taxes. So the net income for this small company is going to be EBITDA minus the taxes they pay. So here's the type of company we're going to buy. It's a tax prep accounting firm. So the cool thing about this type of company, it's a needs business. These customers, they have to pay taxes every year. And if they're a business, they have to do bookkeeping every month. They generally are doing bookkeeping on an ongoing basis, but at least once a month, they're going to have to pay a bookkeeper to keep their accounting records, because businesses have to pay taxes and they have to have accurate accounting records to know what their tax is going to be. So customers, civilians, everyday people pay taxes. Businesses pay taxes too, and they have to hire an accounting firm or bookkeeper to keep track of their numbers, the business's numbers. In this example, this company has 400 clients. Now, these are not ice cream store or candy store clients who come in every once in a while. These 400 clients are showing up in a dependable way every year. So this is a needs business. This is a really cool way to think about. This is a safe way to acquire a first company. It's a pretty safe business to buy. We've got a reliable customer base. We know, unless we really drop the ball, they're going to keep showing up and paying for our services. So in this case, 400 clients, the average fee in this example is $600 per year from each of the 400 clients. The total annual revenue is 600 times the 400 clients. This company is making $240,000 a year in annual revenue. And so that's the gross revenue that the company is making before subtracting anything off of that. The next thing we want to get is the churn. Churn for a business. How many customers do they lose? How many customers do they gain annually? So in this case, this example, this company is losing 10% of their clients. That's 40 clients. And they're gaining 5%. They're gaining 20. So they're losing 40 every year. They're gaining 20. So there's sort of three ways a business, its current condition can be in. It's either growing, or it's staying the same, or it's losing customers. In this case, this is a declining business. They're losing 40 and they're only picking up 20 per year. You can use this when it comes time to negotiate the price. You can point out to the seller, your business is declining, so we're going to have to negotiate the price. So getting the churn, these numbers is pretty vital when you're buying a business. If the seller doesn't know, then one of the things you should do anyways is to ask to see their Schedule C, their Form 1040 Schedule C, which is operating profit or loss from business. And they should be reporting that revenue. They should be reporting all these numbers. And if you ask for the most recent 2 years, let's say that 2 years ago they made 300,000, and last year, they made 240,000. So they're declining. The business is declining. So if the owner does not want to show you the Schedule C that he or she files for that company, you really need to think long and hard about whether or not to proceed at that point, because they should be reporting their numbers to the IRS. If they're not, if they're willing to be unethical with the IRS, that's commentary on, because it's pretty rare that a person who will not disclose to the IRS, that's the only area of their life where they're doing something like that. So you should be able to see the Schedule C of the seller and verify the revenue numbers and the other numbers. You need to know the churn. You need to know, is the business in trouble? Because if you buy a troubled business without knowing it, this is your first business and you don't have any experience, you could be in a world of hurt, right? You need to know what the churn is. Because you can fix, if the company is not doing well because they're losing more clients than they're gaining every year, you can fix that. But if you don't know you need to fix it, you won't even look for it. And since you're an inexperienced operator, this is the first business, you should know this in advance so you can know how to proceed. The first thing you'd want to do is figure out, is the marketing not working? Is the advertising not working? How come we're losing more than we're gaining? Okay, so the next thing we want to look at is, we know what the revenue is, 240,000. We know what the churn is. Next, we want to know the cost of goods sold. This is the outflow of money from the business that pays for the activity in the company that produces the tangible thing that customers buy from the company. In this case, tax prep and accounting services. So the cost of goods sold for this business, this example, there's 2 accountants. They each make 50,000 a year, so the total is 100,000 a year, and they use software to produce the thing that gets sold by the company. They use QuickBooks. It's a $2,000 a year subscription. The total cost of goods sold is 100,000 plus 2,000, 102,000. Okay, now that is the expense that directly creates the tangible thing the company sells that customers pay for. The business has other expenses that do not create the tangible thing the business sells, like rent and utilities. That's 12,000 a year in this case. Marketing, website ads, another 6,000 in expenses. Liability insurance, 3,000. So the total other expenses, $21,000. So the gross profit is the revenue minus the cost of goods sold. So it's 240,000 minus the 102,000. So the gross profit is 138,000. The EBITDA, these are the earnings before interest, taxes, depreciation, amortization, is 138,000 minus the taxes. Sorry, it's the 138,000 gross profit minus the other expenses, the 21,000, 117,000 annually. So the net income, this is what the new owner can take home, 117,000 minus the taxes, 93,600 in this case. This is a 20% tax rate. That's the assumption. So this is for the new owner, for the buyer, they can look at this number and they can say, okay, this is a paycheck. This is 93,600 a year that I can take out of the business. I'm paying accountants 100 grand. I've got the other expenses. And for me, my portion is 93,600. So you might say, okay, that's in the grand scheme of things, that's not a huge number. But if you watch this video from yesterday, I talk about buying a succession of these businesses, creating a larger entity, and having a sort of a backroom number crunching, consolidate all the activities. So instead of having 10 of these companies times 2 accountants each, 20 accountants, if we consolidate all the activity, we end up with maybe 10 accountants or 8 accountants. So the expenses, the cost of goods sold drop, and we end up with close to $1 million in net income. And in this video, I talk about over a period of time, a period of up to 5 years, buying 10 of these companies. So you end up at the end of 5 years with $1 million in net income. Not bad. So, but this is just the first business. So the asking price is always a multiple of the EBITDA. That's just the standard when you buy a business, there's a certain multiple that is common for each different type of business. For tax prep and accounting firms, we're going to assume there is a 4 multiple, a multiple of 4 that you use, that is by convention is used to multiply by the EBITDA by to get a selling price. So the multiple for tax prep and accounting firms in this example is 4. 4 times EBITDA gives a conventional selling price, a starting point for negotiations. 4 times 117,000 EBITDA is $468,000. So the seller will say, Mr. Buyer, I'm selling you my accounting firm. The industry standard multiple for tax prep and accounting firms is 4. My EBITDA is 117,000. I'm asking 468,000 to sell you this business. The first thing you can do is you can say, right, but you're losing, you're declining, your customer base is declining. You lose 40 and you only pick up another 20 each year. So you're losing 5% of your customers a year. You're churning out 10% and you're growing by 5%. So I want a discount on that price. So that's one approach. Another approach is, Mr. Seller, your churn is such that your company is declining, and I've looked at your Schedule Cs for the last 2 years. The revenue has been dropping over the past few years. So I would normally ask for a discount on your proposed selling price. But here's what I'll do, Mr. Seller. I will buy your business for your full asking price if you will carry a note for 80% of the purchase price, and I will pay you an initial down payment of 20%. And that's a negotiated percentage. You could say, I don't want to put anything down. I want you to carry a note for 100% of the purchase price, and anything in between. That's a negotiating point. But basically, that's why knowing what the churn is important. If the company was growing like gangbusters, then you don't have any leverage. But in this example, the company is churning out and losing clients every year. So there's something going on that's wrong with the marketing. And maybe the execution of, maybe the clients are leaving because the services are not being completed in a timely fashion or something, especially with tax prep and accounting. So that's kind of your 2 approaches. You can say, I will pay your full asking price, but if you're flexible with the means of payment, because I'll pay you 20% down now, and then I will pay the remainder in a series of payments over the next X number of periods, like 6 periods, 6 months each, which would be 3 years. And so you get the idea. Now, I want to say something about this multiple. In yesterday's video, I talked about this. When you buy a small company like this, you usually base the price, the selling price, the price that you pay on this industry standard multiple, in this case for a tax prep and accounting firm. It's 4 in this example. If you follow the advice in this video and over a period of a few years, you buy 10 of these and you create a larger entity, you can sell it for a 10 multiple. For example, it's called multiple arbitrage. I covered that in yesterday's video, where you buy for a multiple of 4 and you sell for a multiple of 10. So you can really increase your wealth over time by not just buying one of these, but buying several. So it's something, it's food for thought, sort of a takeaway from this. But this was sort of an introduction to what you should look at when you buy that first business, how to be careful, how to look at churn. And this is a tax prep and accounting firm. It's a needs-based business. It's a pretty reliable client base. And if you fix the marketing and you fix any execution problems, let's say your accountants are not motivated and they're not, they're slow and customers are leaving because of that. So there are things you could fix if you know about them in advance. If you have any questions about this, I'd be happy to answer any questions you post in the comments. And I really want to thank everyone for watching, and have a great day.